This is part 2 of our chapter 4 video lecture. We'll have a part 3 after this part 2. Let's continue working with different tax characteristics of both taxable and flow-through business entities. Let's again look at flow-through, specifically S corporations. So if you remember, corporations are owned by shareholders. Here's our corporation. And a C-type, their profits would be taxed at the corporate level, and the shareholder would not pay any taxes on these profits unless it was distributed to them as a dividend. And that would be double taxation. So to eliminate double taxation, a corporation can make an S election, and now the shareholder would have to report all of the profits on his or her own return. Again, using that schedule K1 to show the allocations among the shareholders. And generally, S corporations do not pay any income taxes. Let's go on to the other flow-through one that was a partnership owned by 2 or more partners. So here's the partnership. And their profits allocated among the partners, again using a schedule K1, and the profits will not be taxed here at the partnership level, the entity level, but taxed on the partner's return. That's income tax, and also, as we noted in the previous part 1 video, subject to self-employment tax, the Social Security tax. Now you see this profit for the S corporation, subject to income taxes, federal and state, but not subject to the self-employment tax. So in past years and continuing in current and future years, many businesses like to form an S versus a partnership corporation to avoid self-employment tax. And the IRS knows this tactic. So what they want the shareholders to do is, if they're working employees of the corporation, to not only allocate their profit to the shareholders, but also take a fair wage or salary reported on a W-2 like any other employee. And that this W-2 is going to be subject to the FICA taxes. Half of it taken out from the employee shareholders' pay, and the other half paid by the S corporation employer. Now this payment, salary and payroll taxes, is going to reduce the profit that's allocated now to the shareholder, right? Remember, this is the one that's profit that's not subject to self-employment tax, whereas now wages subject to that FICA tax. Okay, let's move on to the next characteristic, where we're talking still about flow through business entities, and they qualify now for the new 20% qualified business income. This is new for 2018. Since corporate taxable business entities are now subject to a relatively low flat tax rate of 21%, Congress wanted to also give a tax break to flow-through business entities, keeping in mind their income is taxed not at the business entity level, but the owner level. So this deduction here is going to be calculated and deducted not by the business, but by the owner on the owner's tax return. Now there's quite a few limitations in this deduction, but for most taxpayers with relatively, I would say, maybe high to and moderate, not very high income, they can just probably take 20% of their business income and deduct that. But if you get into the higher incomes, if you get into certain types of professions, businesses, then maybe you're going to be limited in the deduction, or possibly eliminated from taking the deduction. Let's kind of look at one calculation. Again, you look at your business income, qualified business income. In the case of the Schedule C, sole proprietorship, we learned back in Chapter 1, this would be just the net profit coming off of that Schedule C. Then we multiply this by a flat 20% rate to get the tentative deduction. But this deduction can be limited based upon the taxpayer's taxable income. If it's very high, meaning like $200,000 or $400,000, possibly the deduction is going to be eliminated for certain types of professions like medical, like legal, like us, accounting or finance. If you're in other types of businesses, there's going to be limitations based upon how much wages you pay your employee or how much assets you've invested in the business, operating assets. Okay, so that's an advanced calculation, but we're sticking with the simple one here. So we still look at that taxable income within lower limits. Now lower limits is like 150,000 or 300,000, that or below. And we subtract out any capital gains, net capital gains inside of that taxable income. And this taxable income here is before the qualified business income deduction. We subtract out capital gains, and whatever dollar amount is left, we multiply it by 20%. And the lower of these two tentative amounts here is going to be your qualified business income deduction. You would calculate this deduction not on a schedule, tax schedule, not even on a form. I wish to put it on a form or schedule that we can actually work on and turn in to the IRS to file, but they put it on a worksheet that's in the instructions to the 1040 form. Keeping in mind, this is a simplified situation where the income is relatively low. Again, we look at our qualified business income, and technically we just multiply it by 20% to get that tentative deduction. Then we compare that to the taxable income minusing out the capital gains, and the difference times 20%. We pick the lower of the two to claim the deduction. Again, this is new for 2018. I think it goes all the way through 2025 before it expires. So this deduction now goes back to the new 1040 form, and there's a specific line here, line 9, just for this new deduction. Notice it's right after the standard or itemized deduction. So this deduction is not treated as a business deduction, even though you see the word business in there. It's going to just reduce the taxpayer's taxable income, reducing income taxes, and not the self-employment tax, or not any of those other taxes we mentioned in the part 1 video. Okay, a lot of business owners are excited about this, thinking they're going to be saving lots of money, keeping in mind the tax they're saving on is only federal income tax. Not even the state has adopted this deduction. Let's talk about taxable entities, and that's the C corporation. And for 2018, now they only pay a flat 28% tax rate on their taxable income. In prior years, the tax rate could go up to 35, maybe even a little higher than that. It was the graduated rates, just like individuals. But here, because of the Tax Cut and Job Act, they've reduced the rate down to 21%. And like we mentioned before, if there's extra profits now, the C Corporation wants to distribute to their shareholders. In the case of individual shareholders, qualified dividends are either taxed at 0, 15, or 20%, depending upon the taxpayer's income level. And if they're in the higher income level, maybe the higher 15 or 20% marginal rates, they are also subject to that net investment income tax we had talked about back in the part 1 video. If the corporation is paying a dividend not to an individual shareholder, but another corporation that owns shares in this corporation. That could even result now in a triple taxation of the income, where one corporation pays a dividend to another corporation. So the income is taxed here and here again. And when it pays out the dividend to, let's say, an individual, now that individual is going to pay either 0, 15, or 20% plus possibly that net investment income tax. In fact, if this was a C and continues down, you could eventually tax and tax and tax forever. But to eliminate that double or triple taxation, this corporation receiving the dividend is going to get a dividend received deduction equal to higher rates now for 2018, 50% of the dividend. In other words, you get taxed on half, or here get taxed on 35%, or you don't get taxed at all. Again, this is the deduction you get to subtract out for receiving a dividend from another corporation. And the percentage here depends upon how much ownership this corporation has in the stock of this paying corporation. Pretty much, if you get 100, you're pretty much owning this corporation. You're the parent of this subsidiary here. So we'll cover more of this calculation in a future chapter regarding corporate taxation. Corporations can maybe control whether their shareholders receive dividends, because you remember back in your first accounting class, when you record a dividend, you have to have the earnings, you have to have the cash. The board of directors have to declare the dividend for shareholders that have the ownership on a certain date before being paid out. Well, just don't pay it out. Keep the earnings. Well, the government wants you to pay it out so you can tax that dividend, tax that earnings again. So they have additional taxes to motivate corporations to pay out dividends, here called accumulated earnings tax or personal holding company tax. And to be honest with you, I've never seen this in my life here. Typically, you would be audited, and then the auditor, IRS auditor, would say, hey, you've accumulated too much earnings. You should be paying that out as a dividend. But it's justifiable to keep earnings if you have plans for it, like an expansion, a reserve for a liability, and that would now defer or cancel out any of this accumulated earnings tax. The personal holding company tax, that's something you may have to calculate yourself when you file a tax return. Basically, if you have a small amount of shareholders owning or controlling a corporation, and the corporation has investment type activities, okay, and they're not paying out dividends, yeah. Okay, so that's another topic we'll see in a future chapter. So reviewing the taxation of owners here, in the case of a sole proprietorship, all the income is going to be taxed to the owner. You cannot be an employee of your own sole proprietorship. A sole proprietor, you cannot treat them as an employee. You don't issue out a wage or salary in a W-2 form. Now, you can have employees working for the sole proprietorship, including family members. But again, that is subject to FICA tax, and all of the income allocated to an owner is subject to the self-employment tax. In the case of corporations, the shareholders, if they're working also now for the corporation, they should be paid a fair wage or salary subject to the FICA taxes, paid half by the employer and half by the employee. Any remaining income of the S corporation is going to be taxed to the shareholder, but it's not subject to the self-employment tax. In the case of a C corporation, the remaining income is not taxed to the shareholder, only if it's going to be distributed as a dividend. Only then it's taxed. If you remember that new QBI deduction, that's available to the S corporation, not available to the C corporation. Wage income you receive is not considered to be QBI income, so there's no deduction there. In the case of partnerships, it can get a little complicated. We know that the income of a partnership is allocated to the partners. Also, partners can receive not a wage or salary, but a guaranteed payment, taxable payment from the partnership to the partners. It's considered a deduction by the partnership, reducing the partnership profit that's now being allocated to the partners. So both the guaranteed payment and the remaining income, whatever, after subtracting this out, is subject to income taxes to the partners and self-employment taxes to the partners. Here, this is not eligible for QBI deduction. That's this guaranteed payment, okay? Not the remaining income you're allocating to all the partners. So maybe if you have lots of guaranteed payments, that may be something you want to consider now, not taking, but just keeping it within the profits of the company that's allocated to the partners. Now that profit is eligible for the new QBI deduction. It can probably get complicated, not just for tax purposes, but for income allocation purposes among the partners. Okay, losses, meaning you have revenue minusing out the expenses to get operating losses, not the capital losses or 1231 business losses we saw in the previous chapter. Now, for 2018, this excess losses, you don't lose them, but you get the benefit of carrying it forward. It used to be in past years you could carry it backwards. That's not true anymore. And you can carry it forward to indefinite years. You want to use it up as soon as possible, though, to get the benefit. And the most you can deduct in any one of those future years is 80% of that future year's taxable income. Okay, so this is a kind of modified rules of NOLs from previous tax years, only carrying forward to future years with some limitations. We have losses again, but this time it's for flow-through entities. Yeah, this previous page was for C corporations, taxable entities. In the case of flow-through entities, the loss would flow through to the owners, to the partners, to the S corporation shareholders. But there are limitations in how much those owners can deduct based upon the owner's investment in the entity, or how much they can lose out of pocket, how much liabilities they assume of the business. So this is kind of related, these two topics here. And we'll see this, and also this topic here, passive loss activity, more so probably in our next chapter, our future chapter when we talk about rental operations. If you're an investor in a business and you're not actively working, you're considered to be a passive owner. And if you are allocated losses, your losses are considered to be a passive loss. Generally can only be deducted when you have passive income to offset. If you don't have passive income, you carry over your loss until next year when you hopefully have income, passive income. If not, you keep on carrying it over to a future year until you sell that passive investment. And in that year, you can deduct all of those passive losses you have not used. Again, we'll see this calculation or examples in a future chapter. The next item is new for 2018. Typically, if you you can get past all of these rules here and deduct the loss. There really was no dollar limitation to offset other income you have for that year. But now there is a dollar limitation. $500,000 for married filing joint and $250,000 for other tax filing statuses. I think that if you have more losses than that, you probably have some financial trouble. But in any case, if you cannot deduct all of that loss because of dollar limitation, I believe you can carry over the loss into next year. And that's true here, yeah? And over here too. carrying it over to a future year until you meet the requirements. Okay, go ahead and continue into the third part of this chapter 4 video lecture.